oil powers our cars, heats our homes, and drives global industry. The electricity in your house, the bus you take, even the plastic in your phone, all depend on oil. Because oil is so deeply woven into the global economy, its price affects everyone, everywhere. Oil prices are shaped by a complex mix of economic data, political events, and even the weather. A factory opening in China or a new drilling technology can shift prices worldwide. Countries with large oil reserves wield significant influence, and their production decisions can sway global markets. Political tensions in oil-rich regions, like the Middle East, can quickly become global economic concerns. The stability of oil supply is tied to international relations, making oil markets some of the most closely watched in the world. In this video, we'll break down the key factors that determine oil prices: supply and demand, geopolitics, and market reactions. You'll see how news and disruptions ripple through the global economy. By the end, you'll understand why the price at the pump changes so quickly and what it reveals about our world. Oil prices hit home first at the gas station. When crude oil goes up, so does the cost to fill your tank. This impacts daily commutes, family budgets, and the price of getting to work or school. But oil's influence goes far beyond the pump. Farmers rely on diesel, and transporting food depends on fuel-powered trucks, trains, and ships. When oil prices rise, so do grocery bills, as higher fuel costs are passed on to consumers. Oil is also a key ingredient in plastics, synthetic fabrics, fertilizers, and asphalt. Higher oil prices mean higher production costs for countless everyday items. Airlines and shipping companies face soaring fuel bills, often raising ticket and shipping prices. These costs ripple through the economy, quietly raising the cost of living for people everywhere. A single change in oil prices can affect everything from your morning coffee to your next vacation. That's how a barrel of oil on the other side of the world can impact your wallet. Oil prices are driven by the basic forces of supply and demand. When supply outpaces demand, prices fall. When demand exceeds supply, prices rise. OPEC and its allies like Russia often coordinate production to influence global supply. Cutting production can push prices up. Increasing it can bring them down. Major producers outside OPEC, like the US, also impact supply through innovations like shale oil. On the demand side, a booming global economy means more energy use and higher prices. Economic slowdowns, recessions, or seasonal changes can reduce demand and lower prices. The market constantly seeks balance, but this equilibrium is fragile. Unexpected events, a hurricane, a new oil field, or a strong economic report, can quickly tip the scales. Even small shifts in supply or demand can cause big price swings. The daily dance between what's available and what's needed is what makes oil prices so volatile. Every headline, every new technology, every economic report can move the market. That's why oil prices seem to change overnight. It's a global tug-of-war, playing out in real time. Geopolitics is a major driver of oil prices, and US-Iran tensions are a prime example. Iran, a key OPEC member, holds vast oil reserves. The US is both a top consumer and producer. When conflict escalates, the risk of disrupted oil flows from the Middle East rises. US sanctions on Iran can remove millions of barrels from the market, pushing prices up. Even the threat of new sanctions or military action can send prices soaring. Conversely, diplomatic breakthroughs or signs of easing tensions can bring prices down. Traders watch every statement from Washington and Tehran for clues about future supply. The back and forth creates constant uncertainty, making oil prices swing with every headline. The stability of the Middle East is directly linked to the stability of global energy prices. That's why news from this region can move markets in an instant. The Strait of Hormuz is the world's most important oil transit choke point. About 1/5 of global oil passes through this narrow waterway. Any disruption here, whether from conflict or threat, can send oil prices skyrocketing. Iran's control of the northern strait gives it leverage, and threats to close it are taken seriously. The US and allies maintain a strong naval presence to keep the strait open, but this also raises the risk of confrontation. Even minor incidents or military standoffs can trigger price spikes. Traders build a risk premium into oil prices, reflecting the constant threat of disruption. The calmer the strait, the lower the premium; the more tense, the higher the price. Oil traders live and breathe breaking news. Their job is to predict price moves and act fast, sometimes in seconds. A headline about conflict or a threat to supply can trigger a buying frenzy, sending prices up. News of peace talks or easing tensions can spark a wave of selling, pushing prices down. The market reacts not just to facts, but to perceptions and fears about the future. Sometimes, rumors or unconfirmed reports cause wild swings. Volatility is the norm. Traders try to stay ahead of the curve, anticipating how others will react. This creates a feedback loop. Expectations drive prices, and prices drive expectations. The oil market is a real-time barometer of global anxiety and hope. Every headline is a potential trigger. Supply disruptions, whether from conflict, sanctions, or disasters, can instantly shake the oil market. When oil suddenly becomes scarce, prices surge as buyers scramble for limited supplies. Sanctions on countries like Iran or Venezuela can remove millions of barrels from the market overnight. Civil unrest or war in oil-producing nations can halt production and exports, sending prices higher. The uncertainty of when supply will return keeps prices elevated. Other producers like Saudi Arabia may ramp up output to stabilize the market. Strategic reserves can be tapped to ease short-term shortages. But until stability returns, the market remains on edge. Every disruption is a reminder of how fragile the global oil system really is. When oil prices spike, nations must adapt fast. For importers, high prices mean higher costs for consumers and businesses, slowing economic growth. Governments may cut fuel taxes or tap strategic reserves to provide relief. Exporters, meanwhile, enjoy windfall profits, boosting budgets and influence. But they're vulnerable to sudden crashes. To guard against shocks, many countries maintain large oil reserves for emergencies. Over time, high prices push nations to invest in energy efficiency and alternatives. People buy fuel-efficient cars, companies innovate, and renewables become more attractive. The goal: reduce dependence on a single volatile commodity. Every price spike accelerates the shift to cleaner, more stable energy sources. Oil's volatility is a catalyst for change. The world is learning to adapt, one crisis at a time, and every adaptation shapes the future of energy. Oil prices reflect a delicate, ever-shifting global balance. Supply and demand set the stage, but geopolitics and market psychology drive the drama. A single event, a storm, a sanction, a diplomatic breakthrough, can tip the scales. Price swings ripple across economies, affecting everything from national budgets to family finances. Strategic reserves and spare capacity act as shock absorbers, but the system remains deeply interconnected and vulnerable. Understanding oil is understanding the story of resources, power, and adaptation. The price at the pump is more than a number. It's a window into the world's economic and political health. Watch oil, and you watch the pulse of the planet.